Hey everyone, Eric here. In today's video, I'm going to teach you how to build a talent marketplace financial model. We're going to model out the acquisition and retention of job seekers and employers, project out all the revenues and expenses, and then forecast out 24 months of financials for this startup. Okay, let's get started. Okay, so before we dive into the model, which we're going to do in this tab, I want to go over a few concepts that we're going to be thinking about as we build this financial model. So first off, talent marketplaces, also known as job boards, also known as two-sided marketplaces, are a type of startup where there are basically two separate sets of customers that you need to acquire and retain, and then bring them together to transact. That's why they're called a two-sided marketplace. So the thing that's tricky about these is that you have a separate customer acquisition funnel for each side of your marketplace. So our two sides of the marketplaces are the job seekers, which we'll call candidates, and then we have the job posters, which we would call employers. So acquiring an employer is going to be more of a B2B acquisition funnel, and acquiring a candidate, a job seeker, is more of a B2C acquisition funnel. It'll probably happen potentially on different platforms, definitely with a different sales process, etc. So we're going to have to build out the customer acquisition assumptions separately. Customer retention is also going to be different. So someone posting a job versus someone looking for a job, they're going to have a different retention tail. So we're going to build different models for each of the two sides of the marketplace. The next concept is supply versus demand constrained. We're going to be monitoring to see, do we have too many candidates for the amount of jobs available? Do we have not enough candidates for the amount of jobs available? So we're going to create a ratio, probably active candidates per job. If you don't have enough jobs or you don't have enough candidates, the growth of any two-sided marketplace will slow down if the sides are not sort of calibrated and in sync, growing with each other. So you always want to think about where you constrained. Another concept is the hard side of the marketplace. So with marketplaces, usually if you can grow one specific side of the marketplace, the other side will grow organically. And almost always it's the supply side. So with an e-commerce marketplace, it's the sellers. If you can bring on a lot of sellers, the demand kind of comes in. It's the same with rideshare, it's the drivers. So if you can bring on a lot of drivers, you'll bring on a lot of riders. But with talent marketplaces, this is actually kind of the interesting exception. So with talent marketplaces, it's actually the buyers. It's not the supply side, it's the demand side. So the hard side of the marketplace for talent marketplaces is employers. It's very difficult to get them to post their jobs, to pay to post their jobs on the marketplace, because they're going to have all these expectations. They're going to want to trust that you can drive good candidates to them. The candidates don't have to pay anything. For them, it's just create a profile and look at jobs. So they're going to be much easier to acquire than the employers themselves. So this is something with talent marketplaces that a lot of people think that the hard side of a talent marketplace is the candidates. It's actually the employers. Finally, the monetizations that we're going to employ in our financial model on the employer side is going to be just a single job post. So we're going to have a price to post a single job post bundle, which is going to be 3 posts for 30% off, a subscription. So that's 5 posts for 50% off. Maybe this would be selling to recruiters or an HR department of a larger company that's posting a lot of jobs. Then we're going to have boosted posts. So if you want your post to show up at the top of all of the job posts available, you can pay. It's like an advertising upsell. And then an email list send. So if you want to be featured as most interesting or most exciting new jobs in our weekly email send, you can pay for a placement in the send. And then on the job seeker side, we're also going to monetize them. They can purchase to become like a featured profile. So again, that's like an advertising upsell, and also to be included in the email list send. Okay, and the last thing I want to mention is there's basically infinite ways to monetize a marketplace. I'm just kind of calling out some of the most common ways that we see talent marketplaces monetize, but there are many other ways that you could do it and layer it into the model on your own time. Okay, so now let's dive into this financial model. So we are going to be first forecasting the job seeker acquisition funnel, then the retention of our job seekers, and then the sort of breakdown of what they're purchasing and the revenue associated with them. So that's the featured profiles as well as the email send purchases. Then we're going to go to the other side of the marketplace, which is the employers, the job posters. Same thing, we're going to look at the acquisition of employers, the paid versus organic sort of dynamics, build some assumptions around that. retention of employers, the breakdowns of all of the different things that employers will be purchasing, look at the revenue, look at some supply-demand ratios, and then finally we're going to add up all of our revenue. We're going to look at the typical costs that you'd see with a talent marketplace like this. Then we're going to look at the payroll costs, the additional expenses, and finally sort of our net income or net cash flow in this scenario. See if the business needs any money, sort of any new capital put into it, and of course we're going to have to build a bunch of assumptions into the expense side. Okay, so let's get started. So let's start out with our job seekers. So for the paid part of the acquisition funnel versus the organic part, we're going to say we're going to put $100 per month into acquiring job seekers. Again, this is not the hard side of the funnel. This is just getting people to create profiles, basically. We're going to say $100 for the first 6 months. Cost per click is going to be $2.50 a click. And so what does that get us here? That gets us $100 divided by $2.50 a click. That gets us 40 clicks. So 40 clicks a month. And we're going to say that this part of the funnel is going to have a high conversion rate. Maybe it's just single sign-on. So you drive people from an ad to the website to say, do you want to get a great online job? Click here with your Google profile, and maybe it sucks in the information from your LinkedIn. So it's very easy. So we're saying that, let's look here, 40 clicks times a 5% conversion rate. We're rounding that to 0 digits. So we're saying that this is 2 conversions. So what is the job seeker CAC? We spent $100. We got 2 new profiles created. So $50 CAC for job seekers. So this is the first 6 months. So let's forecast this forward now, and then we'll look at the organic side. So let's say after the first 6 months, that's when we start to scale up. And again, we'll forecast the employer side down below, but first let's just look at the job seeker side. Obviously, I've gone through these assumptions before I built the model, so I'm building a model that represents sort of growth that is pacing similarly on the job seeker and the employer side. So let's say we bump it to $1,500 a month. So now we're acquiring 30 conversions, so 30 new job seekers per month on the paid side. And over this time, we also have on the organic side, let's say we are really active on social media. Maybe we already have a small email list from another business, or we're an influencer or something. So we're saying that we're going to basically be acquiring candidates organically as well. So maybe this is even through word of mouth. So we're saying 30, we get to 30, and then by December, we're up to, so 30, 40, 50, 60, maybe 80, 100, 120. Okay, so here you can see that we're basically scaling up sort of some paid profiles, but at $50 a profile, that's not a sustainable way to kind of build this company. So we need to have a very aggressive organic strategy as well. So at a certain point, you'll probably start to get some network effects, meaning as you acquire paid profiles, those paid profiles will start to drive word of mouth, which will drive in other organic profiles. Maybe your email list starts to grow, your social media list starts to grow. So at some point, we can kind of just say, we can create a ratio of paid to organic. So for every 1 paid profile, we'll have a certain amount of organic profiles come onto the platform. So let me show you kind of how to think about this. It's a helpful framework for sort of scaling your acquisition. So let's say now we bump this to $2,500 a month through June, and that gets us 50 paid profiles a month. And let's say our paid to organic ratio is going to be 3.5 to 1. So for every 1 paid profile we acquire, 3.5 organic profiles come on. That gets us 225. And let's say that, as we scale this thing up, our paid to organic ratio just kind of keeps increasing. So here we finally get to 6, and I think we can just have this continuously increase, each month. So, by the end we have, 9 organic profiles created for every 1 paid. So in this last 6 months, let's bump the advertising budget up to, let's say, 5K. And so here you can see that the paid profiles are driving the organic, and total we have 1,000 new profiles coming onto the platform. But just because we have, for example, 80 profiles coming onto the platform in August, well, then after August, in September, how many of those 80 profiles are still active? So let me show you how to do this forecast. So the best way to think about user retention over time for a marketplace or for an e-commerce business, basically any business that's not a subscription-based business, is using something called customer cohorts. Customer cohorts show us the user behavior over a long period of time where there are inconsistent drop-offs. So let's just kind of dive straight in so that you can understand this concept. So a cohort is the original month where you acquire a group of customers. So if your January 2024 cohort would represent the 7 customers that bought for the very first time in January 2024. And then what you look at is, following these 7 customers, what is the projection for their activity over time? So let's start with these 7 customers. So here we have 7 customers coming into the platform in January 2024. And this is considered M0 or month 0, because this is basically the first month of their lifetime. They bought, and now we're thinking about, what about in M1, 1 month later, M2, 2 months later. So in M0, you have 100% of your customers that come on the platform. But what about 1 month later? So I'm saying that because it's a user-based sort of platform, that we're going to have about a 50% drop-off. So of these 7 original customers, we're only going to have about 50% of them still active a month later. So the way that we forecast this, and I'm going to use a round formula because we want to round it to a whole number, is I'm going to take the 7 and I'm going to multiply it by the 50%. So 7 times the 50%, if we round that number, is 4 active customers. And so this is 1 month later, so that's February 2024. Now what about 2 months later? So I'm going to say that then the drop-off goes to 30%. So of the 7 original customers, 4 were active in February, then only 2 were active in March. And then let's kind of look at a kind of a drop-off over time. And generally, a year out for sort of a user-based app, maybe 10 to 20% user activity at the end of the year. Those would be your power users who continue to apply to a lot of jobs, I think would be a reasonable benchmark. So I'm going to say 25, and then maybe this goes down by 1% per month to through the first year. So at the end of the first year, we're at 17%. So here you can see this sort of is just 2 customers are active, then it's 1. And if we go through the full sort of 24 months of this cohort, then after the 17% at the end of year 1, I'm saying that it drops 0.5% a month. And so by the end of year 2, we have about 11% of our original customers that we acquired in month 0 who are still actively applying to jobs on the platform. So we're going to use this assumption for all of our cohorts. So here in February, we do the exact same thing. So this is our February 2024 cohort. And so what we can do is we can just take the same formula, copy it down, and say, okay, we have 12 customers. Then we retain 50% of them a month later, then 30% of them 2 months later, then 25% of them 3 months later. So what this allows us to understand is how each cohort performs over time, knowing that each cohort starts at a different time. So we're saying that of these original 12 customers that we acquired in February, a year in, we only have 2 of them left. So now we have 17 customers. So we can say 17 and then 22. And so here basically what we do is we just take the formula, we copy it, we update it, and then we can do the same thing here. So you just want to make sure that when you're in month 2 of the cohort, you grab the month 2 user retention forecast. So we can copy this over and copy this over. And let me kind of show you the power of these cohorts. So we are saying here, we can see in any given month, what is the total active job seekers. So we can see that in month 1, we only have 7 job seekers. We acquired 7, and there are no prior cohorts that have sort of activity after that. But in February 2024, we acquired 12 new job seekers, but then we also had the 4 active seekers, which are in the second month of their lifetime from the original cohort. So here in April 2024, you see we have our 22 new, and then we have these 9 who are from the March cohort, we have 4 who are from the February cohort, and we have 2 who are from the January cohort. So this allows us to understand our user retention in a very granular way. If you have historical data, you can just create averages here based on what you see in the cohorts from that you've already acquired, let's say 6 months ago or a year ago, and you can use those for your projections. So just in the interest of time, I've already written the rest of the formulas down here. And so what you can see is this big sort of triangular looking thing. And this just shows us the tail on all of our different cohorts. And so let's say we wanted to look at, the November 2025 cohort. You can see that in November 2025, we acquired 950 new customers. So you'll see these 950 coming in, but we had 1,561 returning customers, basically from prior cohorts. So this allows you to understand the composition of your active customers, when did you acquire them, and sort of look at that behavior over time. So finally here we have 2,800 active job seekers. Let me just update this formula here. And we're going to use this exact same kind of structure for employers, although their retention behavior is probably going to be different. Okay, so now we know how many active job seekers we have each month. So this allows us to see, okay, there's a lot of job seekers that are dropping off, so we don't expect them to buy anything, but these are the people who are actively sort of looking for jobs. So let's say we have the 2 products that we talked about that they can buy. So most of our job seekers, they won't pay anything, they'll just apply to jobs. But a small percentage of our job seekers might apply to be featured candidate and then be included in an email send. So maybe they want to get in front of more people. So let's say that, we don't roll out these additional monetization features right away when we're launching the job board, but after the first quarter, we say, okay, maybe 2% of all the active candidates are basically paying to be featured in some way. Maybe that's showing up on a display ad on the side of some page or having their profile show up at the top of some page. Then let's say that in July, so 7 months in, we launch to be included in email send. And this is sort of, only being purchased by 0.5% of our active candidates. And this one's a little bit more expensive, but gets you sort of directly into the inboxes of a lot of people. Okay, so in order to figure out how many people are purchasing this, all we do is we look at we use a round formula and we say 7 active job seekers. If 2% of them are purchasing featured candidate upsells, then here's the formula. So you'll see that here, 2% of 37 people is 1 person purchasing it. And so we can copy this formula. Let's just lock the row here for the be included in email send. So let's see the purchase count on these 2 things. So being included, is this right? Oh, okay, so I screwed up that formula. So what I need to do is lock the row on row 47. Okay, cool. Okay, so if I do that, okay, so you'll see that the being included in an email send, so we have 11 people purchasing that, 14 people purchasing that by December 25. So not a ton, but probably we wouldn't be able to promote that many profiles, so maybe that's a decent number for the amount of sends that we're doing. And then we have 56 candidates that we're sort of promoting in one way or another. So in terms of prices, let's say that being a featured candidate costs $49 per month, and being included in an email send is $299. So now we have all the information. We know how many active job seekers we have. We know how many of them are purchasing these sort of upsells. And so the revenue is just purchases times the price. So we know that our revenue is going to be 0 in the beginning, but then eventually it will become a pretty nice revenue stream. So 2,000 eventually gets to 7,000. And remember, job seekers are not the primary source of revenue. It's job posters. So this is a really nice bonus sort of revenue stream that if you can make it valuable, would be worth layering in. So any sort of advertising related revenue streams are always going to be very high margin. And so they'll help with marketplaces a lot. Okay, so now we have our job seeker forecast totally built. Let's move on to the job posters. So these are the employers. So remember, this is the hard side of the marketplace. Hey everyone, one quick announcement. I just wanted to let you know that registration for my training program, Finance for Startups, is now open. If you don't already know, Finance for Startups is a training bootcamp I designed to teach you everything I know about startups. It includes 20 hours of lectures, 5 hours of live case studies and open Q&A sessions, lifetime access to our community, personalized support from me, and more. If you're interested to learn about how you can secure your spot in the program, check out the link in the description below. Okay, back to the video. Okay, so let's dive into the assumptions around the acquisition of employers. Okay, so let's say that in the beginning, we're not spending anything on acquisition of employers. Basically, we're doing direct sales, sort of founder-led sales. We're reaching out to companies that we know, people in our network and saying, hey, can you post a job? We've got this very exciting platform. So that's for the first 6 months. So for the next 6 months, though, we realize, okay, if we're going to grow, we need to, basically scale this thing a little bit faster. So we start spending $2,500 per month, but reaching directly out to the types of people who post jobs, founders, directors of HR, the cost per click is going to be much higher than just sort of getting in front of candidates. So we're saying cost per click is going to be $5, which it could easily be, at least in the US. So the clicks is going to be 2,500 divided by $5, 500 clicks, and then the conversion rate is going to be significantly lower. Could even be much lower than 1%, but we're going to say, we're able to get, 1% of those people to basically post. So we're going to say 500 clicks times a 1% conversion rate gets us 5 posts. And so the CAC for the paid channel is going to be $500. So you pay $2,500, you get 5 posts. Okay, so that's year one. But like I said, in the beginning, probably everything is going to be organic. So we're going to say we have, we're going to acquire 2, then 3, 4, 5, and then let's say 1, 2, 3, 4, 5, maybe 10. Then we kind of go up 5 per month. And so let's say we're kind of going up 5 per month. We're super, super focused. Maybe we have a marketing agency that's kind of helping us do outbound. And so we get it to 10 job posts in a single month. Then we turn on the paid. And so we start to get some of the network effects because we get more organic through the paid. And so by the end of year one, we have 45 job posts come onto the platform. Okay, so again, 45 job posts, but we have 329 active job seekers. And so quickly, I want to go down here. A ratio is probably job seekers per post. We just want to make sure that we have a decent sort of ratio. So job seekers 7 divided by a number of posts. We don't have this number yet, but we're going to keep an eye once we finish our retention forecast to make sure that we are in a good position. Okay, so we have 45 posts. Now we need to really start bumping things up. So we're going to say that in January 2025, we bump the budget up to 5,000 per month. So 5,000, and then we bump the budget up after that to, let's say, 10,000. So again, acquiring the employers is going to be the really tough part of this marketplace. Acquiring the candidates isn't going to be that tough because, you're basically just offering them a job and they don't have to do anything other than create a profile. Okay, so we're going to use a similar sort of ratio here where we say, okay, now for every 10 companies that we acquire on the paid side, we're going to have a certain ratio of basically organic. So I think we can kind of use the same ratio. So let's say, 3 and then just kind of add 0.5 each month. I think it would probably depend a lot on the company, but just for the sake of simplicity, you'd probably have some ratio where companies would be talking to each other. You'd get some level of social media activity. Your email list would grow. So you'd expect the network effects to increase. And then when marketplaces get big, almost all their sales come in organically. So that's the goal. So this gets us to 200 employers acquired. Okay, so I have the exact same formulas written in down below. And so you can see here we have, employers coming in for month 1, and then we have this multiplied by our user retention forecast. And so now we just need to make sure that we have a user retention forecast that we think is logical. So month 0 is always going to be 100% because you acquire the people and you have them for the first month because they're on. And then in month 2, I think in our scenario, we are going to imagine that most people are coming on to just post a single job one time. So a month later, 95% of our employers are probably going to be gone. But it could be that a year down the road or 2 years down the road, they come back and post. So we're saying we have a low base level of retention, let's say 5% per month, but it's consistent and has a long tail. And so, in any given month, we have 5% of the original cohort coming back over time. And so that gets us some retention behavior. So here, I'm just going to expand the cohorts. And again, I already wrote the exact same formulas that we used above. And then I will sum up the job posters. And here you'll see that because the retention assumptions are so low, you don't even get to 1 customer retained until you have a slightly higher number of acquired companies. So here you can see that we don't get a lot of retention behavior. So here in, let's say, September 2025, you see we acquired 170 new customers, and then we had 45 companies sort of return in one way or another. So this is our total active job posters. Okay, so down below you'll see that this ratio should be filled in. So you'll see job seekers per let's say employer, job seekers per employer. So 7 to 1, 9, then it goes down to 5, and then it goes to 10. So this is a ratio where you need to understand, based on the type of talent marketplace that you are, how many applications does each job post need to actually be successful for the employer? Is it 20? Is it 5? What's the quality of your applicants, et cetera, et cetera, et cetera, so that okay, if this number dips to 5 job seekers per employer, you actually might need more job seekers. So that would be a scenario where you would want to crank up your paid or crank up your acquisition on the job seeker side to boost that ratio, and vice versa. So you want to watch these ratios. You need to basically invent these for the type of marketplace that you have. So for instance, with rideshare companies, drive time is one of their ratios. So if the drive time gets too high, people are going to cancel their rides. But if the drive time is too low, it means there's too many drivers. And so the drivers aren't going to be able to pick up enough people to make enough money, so it's worth it for them. So they're targeting some kind of range. It might be 5 to 10 minutes. Or on Airbnb, they're looking for a percentage of nights booked. So they don't want it to be too high because that means there's nothing available. They don't want it to be too low because that means it's unprofitable to list your house or list your property as a host. So you want to always target a range that's good for both sides where no one is really being constrained. Okay, so now let's go through the purchase breakdown. So for the employers, we have, of course, the one-time job posts. Then we have the job post bundle. So that's post 3 jobs for, let's say, a 30% discount. Then you have subscriptions. So this could be post 5 jobs per month for a 50% discount. And so this could maybe, again, be something you sell to a very large company that's doing a lot of hiring, or maybe a recruiting agency, or someone who's hiring a lot of people. Then you have boosted posts, so job shows up at top of search, and then purchase to send to email list. So similar to the candidate, so hottest new jobs, et cetera, et cetera. Okay, so one-time job posts. Then we're gonna have the purchase count. Then we're gonna have the jobs posted, and also let's just go through prices just so we can kind of have that in the back of our head as we're working through our assumptions. So let's say in the beginning a job post is $99, but once we sort of get the job board going, it goes up to $199. So $199 in the next 6 months, and then $299. And $299 is the price that I see on a lot of actually job boards. So I think that is sort of based in reality. So this is 3 job posts for a 30% discount. So we're going to take this times 3 and give the 30% discount, so multiply by 70%. And then subscriptions. So this is the 99 times 5 with a 50% discount. So if you just get the subscription, you just pay $40 more. You can post 2 additional jobs. Boosted posts, we're going to say it's cost $99. And then purchase to send to email list, let's just say it's cost 3 times a regular job post, because maybe it gets you that amount of additional exposure. Okay, so now we have assumptions. So you can see here, job post is $299. People can pay $897 to get their job post out to the email list, and then maybe they get 10 times as many applications. Okay, so now let's look at the breakdown. So 3 of these products, so job posts, the triple job post bundle, and the subscription are all job posts, and these last 2 are advertising. So let's say we start in the beginning, and we're just offering one simple product. So everyone's just doing job posts in the beginning. We're not selling anything else. Then let's say that in Q1 we launched 3 job posts for 30% discount, and let's say that 5% of customers start purchasing that. Maybe that number's too high, maybe too low, I don't know. And let's say in July, we see 1% of our customers actually start buying the subscriptions. Okay? And so now we can see that what's the purchase breakdown? It's going to be, here you can see 95% of our customers are buying job posts, 5% are buying the job post bundle. Here it's going to drop to 94 because if you're purchasing a subscription, you're no longer purchasing the one-time post. If you're purchasing the bundle, you're no longer purchasing the one-time post. So 94% are purchasing the one-time job post, and then you can see people purchasing some of these other job post bundles. Okay, boosted post. Let's say that this doesn't launch until maybe this also launches in July 2024. So we have the boosted posts, and then in Q4 we launch purchase send to email list, and that's 2%, let's say. Okay, so this is kind of the breakdown. So now all we need to do is just say round. So we have 1 active job poster, and I'm going to lock the row so we can copy this formula, times 100%. Comma 0 digits. Okay, so let's copy this formula and take a look at everything. So you can see that in December 2024, of the 54 active job posters, 51 purchased a one-time post, 3 purchased the bundle, 1 jumped on the subscription, 5% of them boosted their posts. So, however they're posting their jobs, and then 2% of them distributed the jobs through the email list. So that's the other upsell. Okay, and then just so that we can see the total number of jobs posted, I just want to basically quickly say, okay, one-time job post, this is 1. The job post bundle, multiply that by 3, and the subscriptions, multiply that by 5. Just so we can see over time, how many actual jobs do we have being posted? And so I think here we can update our ratio. So, we have 54 active companies, but they're actually posting 65 jobs. So I think here we should actually do this ratio, 65 jobs divided by the job seekers, which is 329. Nope, sorry, the opposite. So 329 divided by 65 jobs. Okay, so here you can see the ratios of how many jobs posted. So job seekers per job posted. We just want to make sure there's enough people to apply for each individual job. Okay, now we have the revenue. Okay, so we're going to take purchases, a one-time job post times 99. So we can just copy this whole thing down, and then I'll put a bottom border here. Also, I'm going to put a comma format. Usually when you have blocks of financial data, you'd put the accounting format on the top and the bottom row, and then comma formats here. It's not super important to do that, but it just makes it look a little bit nicer. And then in case this is your first video that you've watched of mine, with financial modeling, you always want to put your assumptions in blue and your formulas in black, so that if you're looking at this model down the line or someone else is looking at the model, this is an industry standard way of formatting your model. So okay, I can change this number, and that'll flow through the model. So let's say I change this to, $500. You can see that's going to flow through the model. But if this is black, I know that I can't change this. I would have to either edit the formula or go back to the assumptions. So just a nice way of organizing your models. Okay, so the total revenue from job posters is here. You see that in the beginning, it's just a couple jobs. At the end of year 1, it gets to $12,000, and the revenue up here is $941. And then finally, we actually get the thing to almost $100,000 of monthly revenue. So $100,000 of monthly revenue with about 300 active companies, that's a pretty nice business. Okay, now let's roll up the revenue here into the income statement, create some assumptions around our COGS, and look at our profitability. This last part of the model will be very quick. The most complicated part of a model, which is 75% of the work, is always customer acquisition, customer retention, and the revenue. The rest of it is usually pretty fast. So let's kind of look at this. So the first thing that I like to put in my revenue section is always some of the high-level metrics to just orient someone who's looking at this. So total jobs posted, I think, is a good one here. And then active job seekers, I think, is another good one to put here. So we can kind of just see at a very high level, how is our company tracking? So there we go. Okay, so for job seekers, let's pull in the revenue. So we have be a featured candidate and then be included in an email send. So let's kind of paste that in. And then all we need to do is just link in the revenue. So let's look at this here, be a featured candidate, and then be included in an email send. And now we just copy that across. Okay. Okay, so we pulled that in. And for job posters, we just did the exact same thing. So we can just copy the names of these different revenue streams. Okay, so I'll paste that. And then just link it in. So link this here. Control C, Control V. Copy this across, and then you can see the total net revenue is just, you add up all of the different sort of revenue streams together. And so our total net revenue ends up getting to $100,000 per month. So that puts us on a $1 million run rate. So a run rate is a concept where you say if we did 100,000 this month, you multiply by 12 to say if we did, this month that we're in for 12 months in a row, what would be our annual revenue? So you just multiply by 12, and that's called your annual run rate. So our ARR in this scenario is 1.2 million. Okay. So now let's move on to our COGS. So for this business, we're going to say that there is like a CEO founder in the beginning, and there is that they, for the first year, are basically doing everything, maybe with one small marketing agency, and then sort of 1 year in that they're going to hire customer support, someone on the marketing team, maybe someone on the creative side, have more consultants. So we're going to just first build out the year one of this. So customer support, there's going to be nobody to begin with, but let's say in year two, we do have someone. So here's a cool way to forecast payroll in financial models. So I like to put in one column just kind of to the left of the names here with a salary. So I'm going to put in 15,000. A lot of companies, like if they're US based, they would have their customer support somewhere abroad. And so let's say they hire a really good customer support person in a different country, and their annual salary is $15,000 US. Okay, so in order to basically build this formula, we're going to go down to some assumption sections down below. So we have our COGS assumptions and then our operating expenses assumptions. So what I'm going to do is say customer support headcount 0, and then here at the end of the first year, we're going to have 1 person. And so here's how we can use this to build the formula. So basically what we do is we say, take the annual salary, you lock that column, that cell, and you just multiply it by the headcount. So, and then finally you need to divide it by 12. So if you just copy that across, you'll see that this basically will show 0, but as soon as this person pops up, it shows, okay, we have 1 person on this team, this would be their annual salary, and it would be divided by 12, so $1,250 per month for customer support. What else is generally in COGS? Let's say we have site hosting, and you always have credit card fees. So credit card fees. Okay, so let's say in the beginning, so this is site hosting. So let's say in the beginning we basically pay like a pre-built platform that makes job boards. There's tons of them, and we pay them $4.99 a month, and that allows us to scale as far as we think we're going to need to within the first 24 months. And it could be that down the line we maybe build something custom, but at this point we're just going to use the platform itself, and maybe that's a better alternative for us. So we can link in the $4.99 site hosting, $4.99. Then credit card fees, what you do is you take your revenue and you multiply it by, it's almost always 2.75% of revenue is the fee that the credit card companies charge basically the merchant. So we just multiply the revenue by the 2.75%. And so your credit card fees end up being $2,800 per month. Okay. Okay, so now you can see that as we scale up, we end up having gross profit margins that are 90%, which a software business should have a very high gross profit margin. 80 can be even 90% plus. So this looks good to me. Now let's go to the operating expenses. So personnel costs. So like I said, we're going to have a couple people here. So let's say we have a CEO, and then we have marketing, and then we have creative. So we have like a designer, we have a marketer, we have a founder, and year one is just kind of like the founder doing everything themselves. And also one thing I want to mention is this business would be a bootstrapped business. So probably the founder put in all the initial money and they're not raising any additional money. So they're trying to keep the team very, very lean and just bootstrap this thing. A lot of talent marketplaces are bootstrapped. Okay, so down below, we're going to use a similar kind of forecast. So we're going to say CEO, marketing, and creative. And so we're going to put in 0 in the beginning because we're going to say that the CEO basically is taking, no payment. And then, and the CEO would also be the owner of the business. And so if there's no outside investors, once the business generates money, the CEO, the founder of the company can pay themselves distributions. Then you're going to bring on, in January 2025, let's say the founder starts taking a salary, they hire someone on the marketing team, and then in the second half of the year, they hire like a designer to design more assets and support the sort of marketing efforts. Benefits, generally, kind of depends on the country, but you would have to pay about 25% on top of what the salaries are for the 401k, pensions, healthcare, all this different stuff like that, payroll taxes. You generally have to pay about 25% more. So in this scenario, we're going to say that the CEO takes a salary of $50,000 when they start taking a salary. And then remember, the founder is also the owner of the company, so they can take distributions down the line if they own 100% of the company. Marketing, let's say this person makes like 100K. And creative, let's say this person makes 60K. Okay, so we're going to use the same exact formula, but we're going to lock the column. So put a $sign in front of the column. Then we're going to multiply this by the head count. And then we're going to divide this by 12. So let me just show you what this produces. Okay, so you can see that basically this takes the salary, multiplies it by the number of people. So if you had 2 people on the marketing team, you could put a second person in there, and it would just update the formula. So here you can see the payroll. And then benefits, what you do is you just take all the salaries and you multiply it by an additional 25%, and that's what it costs. So let's go over here. And then, let's see. Okay, great. So you can see that our total personnel expense gets to about 22K. And then, of course, we have a customer support rep, which is making $12.50 a month. So you can see our personnel expenses coming through here. Okay, then what other expenses do we have? We know we have advertising, so we can go actually grab that from the acquisition sections above. So we have the paid advertising here, and then we have the paid advertising here. So we can link that, copy that over. Okay, what else do we have here? So what are the other kind of typical expenses? So let's say that we have like other marketing. So maybe that's, in the beginning, 0. The founder is just kind of trying to build this company. And then in, let's say like July, so 6 months in, they start, maybe paying for some kind of marketing tool to help them, some kind of like a software tool that helps them do outbound. And then maybe they hire, like a small agency or something like that to help them run some ads. Okay. And then consultants. So yeah, probably the next big bucket would be consultants. So we can say bookkeeper, legal, design, developer. And again, I'm just making these numbers up. If you're building one of these companies, just update this with the real numbers for yourself. But just want to show you how to set all of this up. So let's say bookkeeper is sort of 0. They're just doing it with some kind of software in the beginning. And then $500, they have someone who kind of cleans up their books at the end of the month and just takes a look. But not a very complicated business financially, so you probably wouldn't need much. Maybe legal is $1,000 to set up some of the initial documents for the company, $1,000. And then some more legal here, maybe, once a year, $1,000. And then sort of like every 6 months you have something come up where you have to update your privacy policy, your terms and conditions, et cetera, et cetera. Then let's say design, maybe from day one, you have some people that you're hiring, maybe on a different platform, maybe Upwork or something, to do specific design tasks. And then let's say no developer, but once you start getting into January 2025, maybe there starts to be all kinds of custom things you want to edit the code on the platform and add different features to your site. So you have a developer that you hire sort of on a retainer to make certain changes for you. So your total consultants would be here. Okay, so I think we could say other marketing, and we can say consultants. So other marketing would be here. Consultants would be here. What else would we have? We probably have like just general technology. That would be like subscriptions, etc. And then I always like to have miscellaneous expenses. So that's just sort of everything else. Okay, so technology. So did I have these down below? Okay, so technology, let's say, is in the beginning maybe $250. Maybe it's like your email marketing tool. And then in January, when you bring on a marketer, this person says, okay, we need some different tools now to do this in a more robust way. So you have more subscriptions to different enterprise software tools. And then let's say miscellaneous expenses is like $500 of just kind of random stuff that comes up. And then $1,000 after that. So this could be trips, this could be meals, this could be, gifts to customers, et cetera, et cetera, et cetera. Okay. So now let's pull these in. So technology here, everything else here. So if you copy that across, you see your total other OpEx is 2,000, 1,000. Then it eventually gets up to about 25,000 a month, but a lot of that is just driven by advertising. Then if you look at your total operating expenses, that's all your personnel costs plus everything else. So that's 2,300 a month. And so again, in year one, the founder is bootstrapping this, paying themselves nothing, funding the whole thing themselves. And so the business is losing a few $1,000s a month, but very bootstrappable for this founder, let's say. And then starts to turn a small profit in December. And that's the sign where they're like, okay, let's bring on a team. The business is actually starting to generate, $13,000 in gross profit. Let's scale this thing up, even if we have to go back into the red as we scale. And so that's kind of the strategy. And then by the end of 2025, the operating income, so the pre-tax income, gets to $49,000 a month. So then the business becomes pretty profitable. I added a little bonus line in here. So there's something called the tax loss carry forward. So if you turned losses in prior years, you can use those losses to offset your future profits. So let's say your business lost $100,000 last year. Well, if it made $100,000 this year, you can actually use those losses and not pay tax on the $100,000 you made this year. And it's only after you've used up all your losses that you owe tax on that. So this tax loss carry forward just basically is a formula that adds up all of our losses. So we can see, when we turn profits, we won't actually have to pay any income tax until we've covered all of our historical losses. So this shows us that, we had accumulated about $39,000 of losses. And so in this month, we did generate $16,000, but we wouldn't actually have to pay taxes because we're still offsetting against those losses. And then finally here, we start to actually have to pay taxes. So you can kind of look at this formula. I'm assuming a 25% tax rate. Finally, after taxes, you have your net income, which in our case because our income statement doesn't have anything like depreciation or any non-cash stuff, this would be the same as our cash flow. So net income and cash flow would be the same in this scenario. And then here you can see that I have a little cell which tracks our cash. So let's say we started, the founder put, let's say $25,000 into the company. And so you see our cash is, basically going down very slightly in the beginning because you have these losses. Then the cash starts to increase a little bit, gets back to 24,000. We get back into generating losses here, so the cash goes down. So we probably actually have to put another, certain amount back in, maybe another 25K, and then maybe another 10K. So this business does take some capital to kind of get going, but again, we're bootstrapping it. And then you can see that our cash balance starts to go up. And then here I have our runway, which is basically just how much money did we lose that month? And we look at how much money we have in the bank and we say, okay, well, if we repeated that month, we could go for 8 more months. So that's the kind of time that you have until your business runs out of money. So this is more helpful for businesses that are consistently turning big losses and have to raise a lot of money, but it's helpful to have in there in case you're a venture-funded business. Okay, I hope this gives you a good idea of how to build a financial model for a talent marketplace or job board. I'll also include links in the description below to other videos I have about two-sided marketplaces. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, check out the link in the description below for a chance to join the next cohort of my training program, Finance for Startups. And if you found this content valuable, please like and subscribe. As always, in the description below, you can download this Excel model completely for free. Thanks for watching, and I'll see you in the next video.